Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It is Macro Monday. Let's take a look at some legacy charts. See how we're doing on that side of the equation here. Just to always start off with some crypto relevant information, inflows, institutional inflows on the crypto ETP side of things, or ETF, ETN, whatever you want to call it. Still seeing inflows largely through BitO, almost all of it's Bitcoin. So not quite seeing inflows into ETH. James even comments here, appreciation in ETH not been followed by inflows. One way you can also track this, something I look at every day just when I wake up because I'm curious, ETF.com. Have a look at the BitO fund flows. I believe each share creation here is 50,000 shares or whatever you want to think of that as. So it's pretty substantial to see an 81 count create. I don't know the technical term there. And I also like to look at BitX now just to see if there's any leveraged flows coming in. This is a 2x Bitcoin ETF. So as bearish as we might be in the near term on whatever the pending news may be regarding Binance, I have no clue. Market seems kind of angry at the moment. There's still pretty substantial underlying currents of people clamoring to get into ETF products before that BlackRock inevitable acceptance, right? It may take a year, it may take Gary Gensler to be gone. It's going to happen eventually. CPI obviously very important as well, not only in the US, but in Europe and globally. That becomes a relative value question. If we're closer to the end of the hiking cycle than other countries, then potentially we see a relative value decline in the dollar. That's my plebeian read anyway. So looking at Truflation, which at this point, again, it's a data point. You can love it, you can hate it, I don't care. It's done an excellent job at forecasting the expectations of CPI, which continue to be down and to the right. Now, we will have some leveling off here when the next CPI print comes in for this month, next month. From a market perspective, still very much on edge on any rise in CPI, just as it saw a nice bump on the legacy side of things on CPI coming in under expectations slightly at 3% as opposed to 3.1, right? Whatever. It just continues to surprise me that people aren't looking at this kind of stuff. But I guess ultimately until the number comes out, this could be plus or minus, 0.25, I don't know, based on this data. We still have a lagging housing component, 6 months lagging in the CPI data, so keep that in mind as well. And largely all the benefits of the energy commodity pricing coming down, the base effect, I guess you could call it, has started to work its way out of the system. So we may be leveling off here in the near term at around 2 to 2.25%. I think the low was actually 2.11 that I saw a couple days ago. So the market still thinks we're going to get 2 more hikes. Well, I shouldn't say 2. The market thinks we're going to get 1. I haven't heard otherwise from any of the Fed speak stuff thus far. The next FOMC meeting is on the 26th. And, something else to look at would be any other leading indicator on inflation. Here's PPI a month ahead against CPI. And again, you can see pretty much in lockstep here, dating back since 2010 from Steno Research. So it's hard to continue to be on the rising inflation bandwagon, at least year over year. Now, we all know prices aren't coming down. Purchasing power is going down. But from a CPI year over year perspective, we've settled down substantially. These are the meeting probabilities. Next meeting again on the 26th. And there's a essentially 100% confidence in a 25 basis point hike coming from the Fed based on the market probabilities, expectations, and then essentially holding there the entire rest of this year with some cuts priced in to 2024. Will this be the recession that never happened? Are we already in a recession? Definitely arguments for both sides, but if you look at transportation numbers, if you look at general anecdotes about activity anywhere, you'd say, well, the market can certainly handle further hikes. Plenty of consumer activity still out there. We're doing just fine. Further hikes may put further pressure on regional banks. I don't know if something else to watch for after the next meeting, but there's also a break here in August. So keep that in mind as well. I just hope the Fed doesn't hike us into oblivion like they seem to be doing here. This is the change in the Fed fund curve, futures curve, from Liz Ann Saunders. And she's basically saying, look at this massive shift here from the comparison of these two dates and what those probabilities look like. Previously, we had been pricing in cuts, cuts, cuts. Now we're pricing in, finally, right, higher for longer, essentially, with no cuts priced in for the rest of the year. Even still, S&P roofing, NASDAQ roofing, NVIDIA roofing, right? Everything is just going bonkers still, in spite of rates holding at, 5.25, 5.5, whatever it may be. I don't have a chart for this, but based on historic rate cuts, that's when you get the recession. That's when you get down markets. So that's the next thing to watch for. Maybe we will tolerate 5.25. Maybe we'll be just fine. What happens when they start cutting? Because they need to start cutting because things don't look as good as they thought they did, or unemployment starts rising again, right? So I still think we're in for a very interesting second half of 2023. And really, I could care less until 2024 because that's when the next Bitcoin halving happens. And that's when we're in for a nice run on the Bitcoin side of things if history is predictive at all. Looking at the TGA, US Treasury General Account, we've refilled this puppy back to 500 some odd billion. That I believe was their unwritten goal effectively. So we've got to that point in the TGA. They may continue issuing bonds. I don't know. The debt, though, has just gotten out of control. The good news is that the bond issuance has largely been paid for through reverse repo. This is just inert money that's not in the system, just sitting with the Fed. So it's sort of moving from reverse repo to the TGA. It's certainly not one-to-one, but the good news for risk assets is that it's not coming from risk assets. You don't have people selling risk to buy bonds, right? At least in aggregate. So as this continues to decline, if it does, that's certainly a good thing for risk assets. This is really, the big problem that most people are pointing to as far as what's going on in the world and why hard assets, hard money, right? Eventually the debt globally will catch up with us. I'm not a doomer, but I am a realist, and this certainly doesn't look like it can go on forever, especially in the United States where we have $1 trillion plus deficit with potentially runaway debt payment interest. I mean, it's a mess, right? This is just something you'd think, assuming this matters at all, right? Either you're in the MMT camp where you're saying we can just print money forever, who cares? Or you're in the camp that says, you know what, eventually something's going to happen here, something's got to give. We're going to lose our status as the global reserve currency. We're going to print ourselves into oblivion, right? This is sort of generally the argument for something like Bitcoin. So my confidence in Bitcoin is based on my lack of faith or confidence in the traditional system, which doesn't seem to have control at the printing press and has no ability to understand the potential issues here, right? Because if they did, they would reel this in, but they're not. So one option is to just inflate the debt away, right? And that certainly should be beneficial for Bitcoin. Another issue here is housing. Housing generally, if you think about it, is really the entirety of the consumer side of things. Think of all the things you buy related to the house, the upkeep, the maintenance, the stuff you put in the house. Housing's important. Cars are important. And as the Fed keeps hiking, 30-year mortgage rates are hitting multi-decade highs, right? And the difference between mortgage rates in the blue here today versus mortgage rates historically, historically houses weren't as expensive as they are. And you'd think, all things being equal, net, houses would need to come down on average, price-wise. But that we're not seeing that. We're certainly seeing a decline, the red line here. Median sales price of houses in the United States. Highly regional, right, depending on where you're at. But the problem now is rates keep rising for mortgages and home prices not quite falling as quickly, right? Pre-2021 prices on average. Still quite a bit lower here. So things are becoming more and more unaffordable. And just some color from Walter Bloomberg about homes still selling. And really the issue is now, if you've locked in your low rate, you're not going to sell for a higher rate mortgage. And we still need tons of people who need houses. So there's definitely a demand there. The whole thing's a giant mess. So we'll see how this pans out, but certainly not great for the consumer based on how these numbers are panning out. Realistically, you need you need housing to effectively collapse to get realistically some sort of decent affordability. So as much as a non-home owner as myself would enjoy a housing collapse, I think that'd be catastrophic for the country. All right, let's take a look at some charts. DXY continues to be the easiest, simplest, streamlined way, in my opinion, to look at crypto risk, headwinds, tailwinds, as DXY was rising rapidly in 2022 in 2022 based on those rate hikes. As we all know, crypto did extremely poor as DXY is coming back to reality here, selling off pretty substantially in the past 2 weeks. We haven't yet seen a tailwind for crypto yet. Now, you could argue that there's some disconnection there because all the people who were trading crypto on the institutional side in 2021 and 2022 are gone. You could argue eventually we will reconnect and those correlations will reconnect, but they haven't yet. So this is sort of an underutilized bullish tailwind coming for crypto yet. And historically, we've done best when DXY moves from 100 to 90 over time, slowly, right? This isn't going to happen in a day. It's not going to happen in a couple months. It's probably going to happen over the course of a year. But we do continue to look weaker on DXY and just measuring out this pattern, descending triangle, call it whatever you want. 96 to 98, certainly reasonable. So it's good that we saw a weekly close at these levels because that for me seals the deal that we're probably going to continue to go lower here on DXY over time, on balance, right? There's no rush. Halving's a ways away. We got plenty of time, okay? So what we don't want to see here, if we're bullish crypto, is anything above 103, 105, any higher high territory. In the near term, that would threaten us more so than we already are, just, sort of sitting here at 30K or whatever we are at the moment. I talked about this a little bit yesterday, but S&P, NASDAQ continue to worry me because everyone is bullish now, right? As opposed to everybody being bearish at the bottom. And we're getting more and more evidence for rising wedge, parabolic advance. We're hitting our technical targets. Now, there's still a pretty wide range we could hit from 45 to basically an all-time high retest. But for me, the risk reward just isn't here. We're not seeing what I would call bullish continuation or bullish reversal like we were in, beginning of the year. So for me, the TA side of this trade has essentially came and went. So I wouldn't want to be turbo long up here, even if this thing retests the all-time highs and keeps going, right? From a TA perspective, it just says, be careful, be careful, be careful. There are people who are still turbo bear, right? Charlie Bolello, not one of them, but here's a great breakdown of the previous bear markets, the duration, the drop down, right? This is, to me, right, bear market's over. Obviously, it's been over. And just looking at these comparisons, it's not like we're waiting for some massive drop here before bearish continuation. Realistically, we could drop all the way back to 4,200, still be totally fine from a trend perspective. It would get ugly. People would get nervous. But we could also just keep chopping around from 35 to 4,500. I just don't have a great read anymore beyond this multi-month consolidation. And you're seeing different versions of this play out broadly on pretty much every chart that, I care to point out. So Coinbase, Robinhood, I'll look at those in a second. ETH has a version of this, right? Bitcoin had a version of this. NASDAQ certainly had a version of this. NVIDIA certainly had a version of this. MSTR had a version of this. So all of those charts essentially to me are in the same position where, maybe not Bitcoin spot, but we're reaching a point where we're hitting our targets and we're ready to take profit on a lot of those trades. NASDAQ, again, same thing. Here's that multi-month, call it whatever you want, right? Multi-headed head and shoulders, multi-shouldered head and shoulders. I don't care, right? It's a mess, but very clearly we broke out beginning of the year of the diagonal resistance, had a throwback at the neckline, kept going, right? And now we've got the early trappings of bearish divergence. This is another one where, is it a rising wedge? Is it an all-time high retest, right? We're way beyond the technical targets that I would measure up here. So again, I would just be cautious. That's all. And really, on the Bitcoin side of things, we've done best historically when we've outperformed legacy, whether it be SPX or NASDAQ, for an extended period of time. So if you look at these charts against the 20-week moving average, as bullish as we've performed this year, we haven't quite outperformed NASDAQ enough, in my opinion, for people to pull assets or reallocate accordingly into Bitcoin versus NASDAQ, right? Now, we've done reasonably better against the S&P, but really people only start to get nervous, when we are in these multi-month uptrends. And it's a pre-halving year, it's early. Not saying this can't happen down the road, but I would just allow this to temper expectations, right? If, for me, most of the money's in institutional and not in crypto, where it's more of a PvP, player versus player situation, where the money in the system is just moving from one thing to another versus new flows, we're not quite seeing that outperformance where, in my opinion, people would start to perk up and say, oh, let's start allocating into Bitcoin. Now we're seeing that on the ETF, ETP, ETN side of things relative to the BlackRock ETF expectation. But price-wise, not quite seeing that yet. So this is something to look at. This is one of those things you can just put on your chart as like an RSI, basically, just to remind yourself where Bitcoin's going to start to get attention relative to traditional markets again, because we're doing better, right? But we're not quite catching eyeballs just yet, in my opinion. One thing relative to divs. So when we look at this NASDAQ div, right, you get people like me saying, oh, this is a bear div, right? Sell it, short it, whatever, get out of your longs. But in reality, I just love the 2015 oil chart because there's so many lessons in here from a TA perspective. One of them would be, look, bear divs can last, bull divs can last for a year, right? So much like Bitcoin historically has held a bear div and just kept going, there's nothing to say that the S&P and the NASDAQ can't do the same. NVIDIA certainly has done that already. The TA is just trying to help you in your decision-making process, right? Leverage, sizing, risk, however you want to think about that. So can we go higher on NASDAQ? Sure. Am I going to adjust my risk when I see those kinds of pictures? I am, but that doesn't mean there's plenty of profit, right, left in the tank. Now I know this is oil and it's held with a cartel and blah, blah, blah. But I think a lot of people have in trading a failure of imagination when they don't realize things have happened historically and they need some sort of example to say, oh yeah, of course. Like people may even argue this isn't even a div. I don't know. But my point is we made lower lows continuously on less momentum over the course of the year in 2015 on oil. So it's possible it can happen. Looking at oil present day, for me, we're still bearish. The cloud is still bearish. We're still in this bearish channel. I think it's important to look, at least have some understanding at oil based on, that inflation and energy picture. If there's some sort of war escalation in Ukraine, which looks like every day we're ready for that based on how we're sending weapons and M16s and cluster bombs, F-16s, probably M16s too, but we're sending more and more over there. And it just feels like the natural progression here is going to be escalation. So it'll be interesting to see what oil does in response to that, if that happens. But as we stand here, to me, this is still in a bearish channel, which is good from the inflation side of things. Gold as well, it'll be interesting to see what happens with gold. I'm trying to remember what was that, February or March 2022, as far as the invasion, probably somewhere in here on gold. So, if we get an escalation, does gold do better? I don't know what it's going to take for gold to break 2K. Interesting side bet would be what breaks 2K first and keeps going, ETH or gold. Probably ETH eventually, but we'll have to see. This chart still looks like a multi-decade cup and handle, which you're never going to see again in your lifetime, my guess, if this actually plays out. But it still looks very good for higher highs. Lots of people talking about silver lately. Thought I'd just comment on that. Another great chart like oil, just zoom way out on silver and just mark it up, which I kind of did already. And there's just tons and tons of stuff you'll see in here. Again, it's important to see what's even possible first. And you might be saying, wow, this looks just like Bitcoin did in 2022, right? Or this looks just like Stellar did in 2018 or whatever, right? Or Bitcoin in 2018. And you're right, there's a reason people paying attention to chart patterns historically. There's a reason people paying attention to this Wyckoff accumulation profile historically. The difference in traditional markets, metals, Forex is that this takes years to play out versus in crypto, we are on warp drive speed relatively to what happens normally in markets. There is some evidence, decent evidence here for silver also breaking this 26 level. So we'll see if everything moves together, right? If does S&P, NASDAQ risk break down as commodities and metals break up, I don't know. But something to watch for in the next couple months here. Coin had an amazing week last week on that news regarding Ripple not being a security in and of itself based on that ruling. And it hit the yearly pivot. It, in my eyes, satisfied, again, some target at the top of the range. I'd love to see this to continue to consolidate. I'm still holding on to whatever I bought, in the 60s or whatever it was. I still think this looks okay. And if you're bullish long-term crypto in the next 2 years, I think coin is just a fine buy and hold, sort of set it and forget it. That's not to say I love the exchange. It's just, again, where are the flows coming from? They're coming from institutional people. Where do institutional boomers like to get exposure? To businesses like Coinbase, right? When you think of crypto, if you ask somebody on the street, they're going to say Coinbase. That's my guess. So this chart still looks fine to me, but we are reaching early targets on that year-long head and shoulders, inverted head and shoulders. Something else to watch other than the short float, which I keep talking about, but not actually looking up, is, if Kramer says anything about it. That's another sort of death knell in regards to price, depending on what he says. If he's bullish coin, I'd get nervous. But if he continues to be bearish, historically, that's been a good thing, right? He was bullish at the exact top, bearish at the exact bottom. Just interesting anecdotal sentiment type stuff worth paying attention to. Hood, again, I'm not bullish on the exchange and not bullish on the fundamentals of the exchange. I don't use it myself. The list could go on, right? I think payment for order flow is predatory. Nevertheless, the chart is crypto adjacent based on what they have available for trading there. Historically, Doge has been a good profit generator for them, and it's starting to break out of its horizontal resistance here. And much like you see relative value of trades between, DeFi and ETH, or lending and borrowing and layer ones, whatever it is, right? You see that same sort of thing, I think, amongst, exchanges or whatever bucket this may be in with Coinbase. So if Coinbase starts to do well and sort of outperform, you may start to see people looking at things like Robinhood, right? Because it's in the same bucket. That's some left curve thinking, but chart looks good. Targets look fine. One last thing I'll just say about Robinhood is the DOJ still has, 55 million shares of Robinhood that I think are still pending. So they're up about 200 million on the trade since they seized those shares. So something to watch for would be whether or not the DOJ is, auctioning these off or whatever they do. I don't actually know what the rules are for seized shares of stock, but any headlines regarding that and how that may affect price, whether or not, price is at its target, that would be super interesting. If we get to that 16 to 18 level and all of a sudden the DOJ comes and says, hey, we're going to sell these shares, or we sold these shares, or whatever it may be, it'll just be interesting if the news lines up with that price target. So that's all I have for this one. Like, dislike, comment, share, subscribe. If you want to look at anything specifically on the legacy side, just let me know in the comments below, and happy trading.